Right, the time is 10 a.m., so we will kick things off. Good morning, everyone. Thank you in the first instance for joining us. Delighted to see a ever-increasing number of attendees on this session. So welcome to the first presentation as part of Kepler's annual three-day Ideas for Your ISA event. I probably don't need to pass too much comment on markets since the start of the year, but I think it's been a fairly interesting time and perhaps a good time for everyone to be listening to the range of speakers we've got over the next few days. To that end, we've got 15 different trusts speaking over the next 3 days, and I encourage anyone that hasn't signed up to the full spectrum of events to have a look in their calendar, go to the calendar invite, and you'll see a link to sign up to other sessions over the course of the next 3 days. Today, our focus will be on UK, Europe, and the Americas. We've got Invesco UK smaller companies up first. Obviously delighted to be here with Jonathan Brown and Robin West, who I'll hand over to quite shortly. Following this, we've got Troy Income and Growth. We've then got BlackRock LATAM, and then Henderson European Focus Trust. And I think we'll be finishing the day with BlackRock Sustainable North American Income Trust. So a very compelling set of speakers. And I think just from my side, a final bit of housekeeping. I think all participant lines are muted for the duration of the presentations. But if you look in the bottom right-hand corner of your screen, you'll see a Q&A function. Delighted to be here with Kyle Caldwell from Interactive Investor. He'll be running the Q&A session at the end of this presentation. Presentation is expected to last around about 30 minutes, and we'll cover off as many questions as we can at the end. As I said, thank you all for joining. It's going to be a really exciting 3 days, and no better way to start than as close to home as we are with the chaps at Invesco, who, in terms of process and, time at the wheel, they are tried and tested. The trust delivers a very stable, good income, which I'm sure they'll talk to as well. And I think the key for the team here is balance. But I'll hand over to them to talk more around that. And look, thank you all for joining, and we'll see you at subsequent sessions over the next 3 days. Thank you.
Okay, thank you, Hugo. I'm Jonathan Brown. I manage the trust along with Robin West. We've got a short presentation which will take you through our investment philosophy, a little bit about smaller companies, how we see things developing and how that translates into positioning within the portfolio. So I'll just take us down to the first slide, which is around investment philosophy, which for us is relatively simple. We're looking to buy good quality businesses with lots of growth potential at sensible valuations. And by good quality, I mean we're looking for companies with high margins, good returns, and some kind of sustainable competitive advantage, which means that won't be competed away in the short term. We like companies with pricing power. That means businesses that can raise prices to offset cost increases, and clearly in the current inflationary environment, that's particularly important. We like companies with strong management teams, and we always meet management before taking a position in a new company. And we like companies with very strong balance sheets and conservative accounting policies, which means profit turns into cash over the medium term. If it doesn't, that's often an indicator that there's something not right about a business. We do a lot of company site visits and management meetings, so we meet around, I'll do around 300 of those sorts of meetings every year. So it's a big part of our analysis with businesses, and we think it's very important to not only meet the people running the businesses, but actually visit the premises and get a feel for how well invested a company is, and what it does on a tangible day-to-day basis. We've got a very long-term investment horizon, so the average holding period for companies within the trust is around 4 years. Clearly, we've owned a lot of businesses for much longer than that. And typically we run with a portfolio of between 70 and 80 stocks, which gives us enough diversification to reduce company-specific risk, whilst having sufficient holdings in the businesses in which we've got the most confidence. Robin will take you through the next slide, which will tell you a bit about the smaller companies sector.
Thanks, Jonathan. First, wanted to start by reminding you how strong a performing sector the UK small companies sector has been. If you look back at the history of our benchmark index, which is the Numis Smaller Companies Index, that's the bottom 10% of the UK market. The compound annual returns of that index are some 14.6% going back to 1955. Now that's very strong in absolute returns, and it's also some 3.4% ahead of the return on the FTSE All Share. So it's a strong performing sector that's outperformed its larger brethren. Against that backdrop, we've delivered an outperformance against that strong performance. And if you look at the investment trust share price performance, the total return over the last 10 years is 330%. Again, compared to the all share, that's 104%. So we've got a track record of out delivery against a strong performing benchmark. Now is now an interesting time to be looking at small companies. Now, it won't surprise you that the answer we think is yes. There's a number of reasons behind that. Firstly, UK and particularly UK small companies, since the Brexit referendum, they've been shunned as an asset class. Investors, both domestic and international, were concerned about the what sort of deal, would we get a deal with the EU? What would that mean for the economy? What we've seen is since we've had a deal signed, Boris has signed his deal with the EU, although it may not be ideal and things will be need to be tightened up, that's given companies the confidence to start reinvesting, and also investors to start looking again back at the UK market. Second reason to look at the UK is that we were one of the fastest growing developed economies in 2021, and we're still forecast to be one of the fastest growing developed economies in 2022. And there's a number of drivers behind that, both business investment, the support that the government is giving, and the consumer has ended up post-pandemic with strong balance sheets. And finally, and I've got a slide coming up on this, if you look at the valuations of the UK relative to its long-run history, we're looking at pretty attractively valued, and that's even more so after the recent market setback.
Okay, so we'll take you over to the next slide. What happens next? Now, clearly, the balance of this year, the situation in the Ukraine is critical to how that will play out. It's impossible for us to know what the duration of this conflict will be, or the likelihood of some kind of ceasefire. The major impact from this has obviously been in the energy markets. Both the oil and gas prices have increased very significantly. However, it should be noted that global oil production has not declined because of this crisis, nor has global consumption increased. So a lot of what we've seen in terms of energy prices is speculative behaviour. And if we get some more positive developments, we could see oil and gas prices back to pre-crisis levels relatively quickly. So with that in mind, we're trying to run with a balanced portfolio, both with some cyclical exposure, so businesses that are sensitive to the broader economy, but also with defensive businesses and companies with self-help characteristics. Ukraine aside, the UK looks pretty well set. It's forecast by the OECD to grow more rapidly than the other developed economies. So the economic backdrop, Ukraine aside, looks pretty solid. Clearly, the cost of living is increasing, and this recent spike in energy prices is certainly unhelpful to that. However, it should be noted that household balance sheets are in their strongest state for many years. And also, we are seeing an acceleration in wage inflation, which does provide some partial offset to the increase in the cost of living that we're seeing at the moment. As Robin touched on, business investment has been recovering since the beginning of last year, which is obviously helpful for the broader economy. And the government is being supportive in terms of infrastructure spending. And this is true whether you look at big projects such as Hinkley Point Nuclear Power Station, HS2, but also the more significant spending on roads over the coming years. So inflation is clearly a risk at the moment. But as I mentioned earlier, we like companies with pricing power, and certainly in the conversations we've had with businesses so far this year, they've managed to increase prices to offset cost inflation and to maintain margins. So the next slide talks to the positioning in the portfolio, and so it is a pretty balanced portfolio at the moment with some cyclical exposure. Businesses exposed to higher growth niches and self-help stories as well within the portfolio. We continue to have a preference for businesses with pricing power. I mean, that's always been the case. We like companies with differentiated products and services, but that's particularly important at the moment. The significant derating we've seen in technology and growth stocks is quite exciting to us as investors, and this is an area of the market that we reduced our exposure to through the COVID-19 pandemic. A lot of businesses within these sectors achieved extremely high valuations, and we saw that as a good opportunity to take some profit and invest in businesses that would recover as we emerge from the COVID crisis. What we've seen over recent weeks is, in many cases, growth in technology businesses halving in value, and this is throwing up all sorts of opportunities for us to either rebuild positions or add new holdings to the portfolio in these sorts of areas. We remain focused on our 4 key themes. We've got a slide on that later, but we'll talk you through the kind of things that we're finding interesting in businesses we're meeting at the moment. Robin will take you through some slides over the next few pages to outline some of the things we've been speaking about.
Thanks, Jonathan. This chart shows the MSCI World Growth Index, the trailing 12-month price earnings ratio, and this is really just encapsulating what Jonathan was saying about when the pandemic hit. What you saw was a very crowded trade. People were looking to invest in companies that they felt had certainty, and a lot of these were technology-based businesses. So they entered 2020 already on pretty high multiples, and those multiples increased dramatically over the course of 2020 and peaked at levels that were actually in excess of what we saw at the turn of the century with the tech bubble. As Jonathan said, our reaction to this was to take significant profits out of a number of these names. We like the businesses. We can see there's a lot of growth there, but we just felt the market was paying far too high a price for that growth. What we've seen with an environment where inflation has been increasing, where interest rates expectations are increasing, a lot of these valuations of these growth names are predicated on discounting cash flows at very low interest rates. It doesn't take much nudging of interest rates to make those valuations come back a long way, and that's what we've seen over the course of the last 6 months. And as Jonathan highlighted, we are now seeing stocks back at levels that they're not bargain basement, but we think the risk reward balance is back in our favour. Can we have the next slide, please, Jonathan?
Sorry. Okay.
This slide looks at a number of different global markets. So we're here looking at forward PE ranges, and the dark blue bar shows the range between the 20th and the 80th percentile. The pink, or I guess pink purple dot shows where the markets are trading. And what you can see is that for most global markets, and US in particular, we're trading well in excess of where the historic trading ranges were. The UK, which is down the bottom, is one of the few beacons of value in the market, and valuations have moved down even further from where this is. So we see the UK as being one of the best value markets globally. Final chart is again just highlighting the impact that the Brexit referendum has had on valuations. The two lines here, the dark blue line is looking at it's a composite of a number of different valuation metrics, both the PE ratios, EV/EBITDA, and price to book. And the light blue line is where the UK market is traded. And what you can see is, going back over history, the UK and US tended to trade pretty much in line with each other. Post-Brexit referendum, you've seen a yawning gap between the valuation of US stocks and UK stocks, and indeed UK and rest of the world. And so that, as we say, is one of the opportunities of looking at UK small companies again.
This slide outlines 4 key themes that we find attractive in potential new holdings. So the first column here is self-help and recovery, and this can either be businesses that can invest to generate their own growth, or companies that have had a difficult trading period but have some kind of turnaround plan. A good example would be Ultra Electronic, the defence business, which historically got into some difficulties trying to grow its business too quickly, which led to a degree of aggressive accounting within the business. They had a change of management team. We met the new management team as soon as they arrived, and they had a very credible turnaround plan for the business. And what we've seen over the last few years is a reinvigoration of the growth profile of the business. It is exposed to some higher growth niches within the defence sector, so things like electronic warfare, cyber security, marine warfare. So it's a really well-positioned business. And we've also seen accounting policy become much more conservative, so the cash conversion of profit into cash flow has improved very significantly. And this culminated last year in a bid for the business by Cobham, which is another UK defence business. And that resulted in quite an attractive exit price for shareholders. The next column is actually 2 things, really. The first one is rollouts, and these are businesses with an exciting proposition that can be rolled out more widely. So a good example would be Gym Group, which is a low-cost gym operator. So you can pay them £20 a month and use their gyms 24 hours a day, which is quite a compelling proposition. What they're finding currently is that the kind of units that they like to expand into, which are typically retail units, ideally on out-of-town retail estates with good car parking, they're managing to find new space at very attractive prices in those kinds of locations. And that's due to a lot of retailers either downsizing or going out of business because of the COVID-19 pandemic. So we see this as a business that can continue to open new units, which gives you very good visibility of growth over the next few years. The roll-up part of this is consolidation stories. And we like companies that can acquire smaller competitors and derive some kind of genuine scale benefit. A good example of this would be CVS Group, which is a vet services business. And what they've done is consolidate the veterinary practice market in the UK. So they buy up smaller chains or individual vets practices and can generate much higher returns by procuring things more cost effectively and by centralizing various functions such as finance and HR. Robin will take you through the next two key themes.
Thanks, Jonathan. The third theme is what we call structural growth. That we always like to invest in businesses that are exposed to markets that are growing well ahead of the general economy. A number of these will sit within the technology sector, and a great example of this is a business called Keyword Studios. We first invested in Keywords back when it were IPO'd, which was almost a decade ago. They are the market leader globally in the provision of outsourced services to the computer game sector. The sector itself is very attractive. The growth rate of the sector has been around 7 or 8% and is forecast to continue at that level. Keywords has successfully grown in excess of that organic growth rate. The sort of services they offer, and initially it started as localization services. So if you're an Electronics Arts or a Microsoft, you'll develop a game in English, but you want to sell it globally. So you need someone to do both the audio transcription and the text transcription. Increasingly, they got into new areas. So they invested in artwork, where they've got some great studios in India and China, where very talented artists will produce the huge amounts of artwork required by games, but at a fraction of the price that it costs in California. And nowadays they've got involved in game engines, so effectively keyword studios can write the whole game for a games developer. They've both an organic growth story, and they've successfully consolidated a number of boutiques operating in the area. So there's a acquisition enhancement to growth. It was a sector and a stock that performed very strong through pandemic as people had more time at home and so spent time gaming. But equally, the outlook's strong. There's a lot of new content required to keep those gamers engaged. So it's a business that we think can continue to deliver. The final category is what we call cash compounders, and these are businesses that have a lot of the characteristics that we like. They've got strong operating margins, strong returns, strong cash flow. They tend to be market leaders in their niches. They'll have decent organic growth, and they'll supplement that by selective acquisitions. A number of the businesses that we categorize here are exposed to the infrastructure spending, which Jonathan has mentioned. So examples would be stocks like Genuit, VP, and Hill & Smith. Hill & Smith, we met the management this week. They're one of the market leaders in providing services to infrastructure spending. So they've got galvanizing businesses in both the UK, US, and in France, and they provide products into the electricity sector, into the transport sector. When we spoke to them, they were particularly excited about the spending bill that President Biden's just put through. Over half their business is exposed to areas where there are billions being spent updating the aging infrastructure in the States, putting in new bridges, putting in new solar farms, putting in new electricity transmission equipment. So they're well positioned. And again, just to reiterate, they've put through price rises in advance of what they're seeing coming through on the cost side of things.
Okay, this is a chart which outlines the discount of the investment trust. You can see historically the trust traded at a discount of around 5%, and then through the COVID crisis, this broadened out. I think we're at a discount of around 14–15% as we speak today, which we think is quite attractive. In effect, you're buying £1 worth of assets for about 85 pence. We're hopeful that the discount can narrow back towards its historical level over time, as hopefully we'll get a more stable period in markets, and that'll lead to more positive sentiment around the UK smaller companies sector.
One of the attractions for the trust for investors is its enhanced dividend policy. This was implemented back in 2015, and Jonathan's already highlighted that we traded a relatively narrow discount of around 5%. One of the reasons for that discount, we believe, was the introduction of that enhanced dividend policy back in 2015. What this means is that we pay a yield of 4% based on the year-end share price. We pay a quarterly dividend, and that dividend consists of 100% of the payment of the underlying income of the portfolio, which historically was around 2%. It's actually, given the share price falls, it's even more than that today. And we supplement that with a modest payment out of capital. As you've seen, we've got a strong total return that we've been delivering over the last 10 years. And so this tends to be a relatively small proportion of the overall return. Importantly, we haven't changed our long run investment philosophy. We still like investing in growing businesses, and we're using the structure of the trust to enhance the dividend. We don't feel we don't want to chase after high yielding stocks, because in many cases the high yield just reflects the fact that there is a lack of growth within the business, or the business is structurally challenged.
Yeah, we have the top 10 holdings on this slide, which typically make up about a quarter of the portfolio. The largest holding we generally have is around 3%. And this is a blend of the kind of areas that we described earlier. So self-help, more cyclical names, and more defensive names. And then the next slide just shows the sector weightings of the trust relative to the benchmark index. The weightings in the portfolio are just derived from where we're finding interesting ideas at a given time, rather than using any top-down view of the economy. We generally have around a third of the portfolio in the industrial sector. It's a very broad sector, and we find lots of companies with the right kind of margins, returns, and growth prospects that we're looking for. And the same is true of healthcare and technology, where we tend to be overweight. We usually underweight financials, and that's because a lot of the businesses there don't have pricing power. They're often quite heavily leveraged and under a lot of regulatory pressure. So we're generally underweight the financials.
We've got a couple of slides just showing the performance, and we look at the top column charts. The dark blue line is the share price performance, and so you can see that just shy of 330% return over the last 10 years. The lighter blue line is the net asset value, and the, call it purplish, bluey purple line is our benchmark, the Numis Small Companies Index. So you can see that over 1, 3, 5, and 10 years, we've delivered performance both at a share price and net asset value level ahead of our benchmark return, and as I say, a strong long-term performance over that period. Performance is one side. The other side is volatility and risk, and so the next chart looks at risk-adjusted returns. So on the y-axis, on the vertical axis, you've got the returns that the portfolio has delivered. On the x-axis, you've got the risk, which is measured by standard deviation. And what you want to be is in the top left-hand corner, so delivering high returns, but in a less volatile way, and you can see that we're one of the, on a risk-adjusted basis, we're one of the top performing stocks within the small companies sector.
And so, to sum up, smaller companies have had a very strong historic performance record, well in excess of the FTSE All Share since 1955. We've got a very consistent approach to investing in the UK smaller company sector, and that's delivered us a good level of outperformance over many years. The trust pays a very attractive 4% dividend yields as based on the year-end share price. And the investment trust is currently trading at quite a wide discount, which hopefully provides an interesting entry point for potential shareholders. And that's the end of the presentation. I think we've got a Q&A section coming up next. So if you've got any questions, please ask them via the question button in the bottom right-hand corner of the screen.
Thank you, Jonathan. Thank you, Robin. Hi, everyone. I'm Kyle Caldwell. I'm the Collectives Editor at Interactive Investor, and I'll be moderating the Q&A. And as Jonathan mentioned, if you'd like to ask a question, please put it in the Q&A box, and I'll try my best to get to it within the 15 minutes that we have for the Q&A. So to start off with, so obviously mentioned in the presentation, there's been a lot of volatility playing out in the market in recent weeks and over the past couple of months. Specifically, how have you been making changes to the portfolio during that time? You mentioned in the presentation that growth and technology were presenting you with opportunities. Are you able to expand at all on that and give some stock examples?
Yes, I mean it's quite interesting to us in that there's a lot of these businesses we found attractive for a long time, but have been just waiting for the right entry point. So we've added a few new holdings to the portfolio. So we bought back into AJ Bell, the investment platform, which is trading at a much more sensible valuation now. Focusrite, which is a technology business focused on music production. We've added GB Group, which helps online retailers to avoid fraudulent transactions, and they sell their product globally. And in addition to those names, we've been rebuilding positions in companies such as Keywords, which Robin mentioned earlier, and also things like Aptitude Software. So it has presented us with some really interesting opportunities to buy back into what are good quality companies at sensible valuations.
And could you run through why UK smaller company shares have sold off more heavily than the large cap names in the FTSE 100 index over the past couple of months?
Yeah, sure. I mean, there's a number of things to point out. I mean, firstly, if you look in a global context, I was looking at around the year-to-date numbers, the Numis Small Companies Index has performed broadly in line with other global indices. If you look at the S&P 500 or what's happened to European stocks or in Japan, the outlier has really been the FTSE All Share, and that's down to a number of things. There's a higher weight within the FTSE 100, I should say, in oil and energy companies, and we all know what's happened to oil prices and commodity prices, and that's benefited the large cap element of the index. Equally, there's a lower weighting in sectors such as some of the travel and leisure and consumer related sectors, which again there's been concern over within with the impact of the tragic war in Ukraine on economic activity, and so those are, and finally, one of the reasons you want to invest in small companies is the exposure to higher growth businesses, and as we've been explaining, there's a bigger weight within small companies in tech businesses than there is in large cap, and those have come back a long way. So those are really the reasons why large is more a case of large outperforming small than the UK per se underperforming globally.
The next question is regarding pricing power, which was mentioned in the presentation. What are the sort of key characteristics that a company needs to possess to have pricing power, and are therefore in a position to increase their prices ahead of or in line with inflation? And has pricing power become more of a focus for the trust, given that we're currently at 30-year highs for UK inflation?
Yeah, what a company needs for pricing power is to have products and services that are either unique or significantly better than other people can offer, which basically means you can't just go down the road and buy it more cheaply from a competitor. You can only really get it from that business. So that's the primary thing, and we always try and understand where a company sits within its competitor set, and to try and understand the unique characteristics of its products and services. It's always been a focus for the trust, really, and it's periods in the market such as this that really underline the importance of pricing power. We always like unique businesses, and we like companies that are just in strong negotiating positions when it comes to price. So it's not something we've moved into recently. It's always a feature of the companies that we look for.
I mean, it's probably worth highlighting. I mean, it's obviously a question when we're seeing companies each day. We're asking about pressure on costs, pressure on wages, availability of of components. And we spoke to Volution in the last week, who are market leader in the UK and a number of global territories, and provision of ventilation into homes. So something that's increasingly important given the pandemic. They put up prices 3 times last year, so they've actually in most more than covered the cost inflation they've seen come through. In some cases, there can be a slight lag of a few months while that works its way through the system. But that's what we mean by pricing power. They've got high margins, which in itself is a sign of pricing power. And as Jonathan said, that's something we've always looked at, but is even more important nowadays.
And when you're meeting company management, are they under the impression that, or are they preparing for inflation to potentially be here to stay for a couple of years at these high levels?
I mean, I think they've certainly taken, in most cases, actions. I mean, there's been a number of drivers in inflation, one of which has been the pandemic and the impact that had on supply chains. And so what we've certainly seen is companies making sure they've got sufficient buffer stocks of components. Where they can lock in prices, they are doing so. So a number of our businesses will have locked in energy prices for 1 or 2 years. So they're cognizant of the inflationary impacts coming through. So yeah, they're doing as much as they can to mitigate inflation, and also say adjusting prices to reflect where costs are sitting.
The next question regarding also mentioned in the presentation, the trust pays a dividend from a mixture of capital and income. You mentioned, Robin, in the presentation that historically 2% of that yield has been generated by the underlying investments, the income generated by them. But you mentioned that it has risen in light of the recent market falls. Are you able to put a percentage figure on what that now is?
I did just run the stats on the portfolio, so and looked at the benchmark. So if we look at the benchmark, we always tend, because of our growth focus, to have a lower yield than the benchmark. But the forward dividend yield on the Numis Small Companies Index is 3.7%. Our portfolio yield is currently around 2.4%. So it's higher than it's historically been. And it's interesting, we saw a number of businesses cut dividends with the onset of the pandemic. In the vast majority of cases, and I was looking through a number of examples, dividends are back at or beyond where they were back in 2019, and corporate balance sheets are generally in pretty strong positions.
And as you mentioned, Robin, that's a function of the share price falls rather than you looking at higher yields in shares, which potentially may not be sustainable.
Absolutely, yeah. I mean, that 15% pullback that we've seen in market is the mathematics means dividend yield goes up.
And I wanted to move on to ask you both more broadly, what is your outlook for UK dividends in 2022?
Well, we think they'll continue to increase, as Robin's outlined. Balance sheets are in a good position, and current crises aside, profitability is forecast to rise over this year. So we see dividends continue to increase from this point.
I think there'll be a mixture of both dividends, and we've spoke to companies where they have got surplus capital. I mean, Robert Walters was an example the other day, the recruitment business. I mean, they've seen their share price fall back, even though underlying trading remains very strong. Generally, a rising wage environment is good for a recruitment business. Their surplus capital, they're both pushing the dividend up, but they will look at share buybacks because they see their shares in the current market as being attractive return if you can buy those where the shares are currently trading.
And the next question for me is, do you both have skin in the game?
Yes. the investment trust, this investment trust and the ICVC we manage is by far the biggest part of my own personal portfolio.
So, same is true for me. I hold it in my ISA and in my SIP. So yeah, when I run through it, actually with Interactive Investor, one of the tools looks at the underlying portfolio exposure across my ISA and pension. The names that come out are the names in the portfolio, just drilling into through that exposure of the trust. So very much aligned to the performance we're delivering.
Well, great. Thank you, Jonathan, and thank you, Robin, for both your time. That's all the questions that have came in. So I'll now hand back to Hugo to conclude.
Brilliant. Thanks, Kyle. And importantly, thank you, Robin and Jonathan. That was a great way to kick off the wider event. Thank you all for joining. Great to see a very strong turnout. And as I said at the start of the session, if you go to your calendar invite, you can see the full schedule and sign up to more sessions over the next 3 days. We've got 14 more managers speaking, so I look forward to seeing you on subsequent sessions. And again, thank you very much to Robin and Jonathan for their time and putting forward a very compelling case for Invesco Perpetual UK Smaller Companies Trust. With that, thank you again, and we'll see you later in the day, if not over the coming days.
Thank you.